Good morning, students. Bill of exchange and accounting treatments. What precisely is a bill of exchange? Let me explain to you with a simple example. Let's suppose a party X sells goods to Y for an amount of, let's say, 10 lakh rupees. And Y says that he needs the goods, but he can't make the payment immediately for his own liquidity position. And X says, I wish to sell now. Doesn't matter that you can't pay in cash. Give me a document which will help me to collect the money from you on a specific date in the future. Now, the second part is what we know already as credit sales. Sales which does not give you cash immediately becomes a credit sales. So in this case, Y becomes a creditor and he can give a document legally known as negotiable instrument by which he accepts to pay the amount of the sales plus if interest if agreed upon by the parties on a specific date in the future, maybe after a month, maybe after 2 months, 3 months. Now this negotiable instrument very often takes the shape of a check, what is known as a post-dated check. Check is a negotiable instrument. In check you say instead of hard cash, you collect it through your banks. So if it's a post-dated check, let us say today is 12th of December 2018 and I give a check for 25th December 2018, it means Y is telling X that I'll pay you or my banker will pay on my behalf on 25th December 2018. Now such a written document can take different shape. Say for example, on a piece of paper, Y says I promise to pay X or to anyone he directs a sum of rupees 10 lakhs on 3rd March 2019, which is roughly about 3 months from date. Now X gets this document which is a promise which can be called as a promissory note, which is also a negotiable instrument which X keeps with himself for 3 months. Go and show it to Y, collects money of 10 lakh rupees. Instead, X wants cash immediately. So he gives it to one of his another creditor from whom he has purchased goods. Let us say A. So X tells to A, look, I have got a promissory note for 10 lakh rupees, which you can collect it after 3 months. My due to you is 9,70,000 rupees. Take this and give me 9,70,000 rupees. Or dispose me of this 9,70,000 rupees. So by giving a promissory note for 10 lakhs to A, he cancels his liability of 9,70,000. So he is suffering a loss of 30,000. But remember that 30,000 will be available to A only after 3 months. Whereas X has discharged his liability immediately. So this is what is known as endorsement. Alright, X endorses to A. What he endorses? The right to collect 10 lakh rupees from Y on 3rd March 2019 as per the written acceptance given by Y. Another alternative X can do goes to the bank. The bank discounts the bill. One of the important services provided by commercial banks is to help X and parties like X to give them hard cash out of the promissory note by deducting some discount for early payments. Bank is not bound to pay X, but they are ready to pay on this bill. So X will endorse this bill to B and get 9,70,000 rupees in cash, right? So this sort of arrangement between a debtor, the buyer, and the creditor, the seller, is commercially known as negotiable instruments and bill of exchange. This is prevalent among traders and among businessmen for centuries. It is not that it is a new thing in the modern world. A person is unable to pay now, he gives a promise to pay after some time in the future. Now, this is a well-known method of meeting current cash requirements. So, we are going to discuss the topic today as how to discuss this bill of exchange and other documents in our accounts books. To begin with, we define what is a negotiable instrument. A negotiable instrument defined in the law means a promissory note. A promissory note means a note which gives a promise by a person who writes that note. I promise to pay. If you happen to see your 500 rupees note, 100 rupees note, or 2000 rupees note, open up. The Reserve Bank's governor is giving a promise. I promise to pay. That's what is mean by promissory notes, right? On a particular date. It is also a negotiable instrument is also a bill of exchange. I just explained to you, or a check, which you know already. Bill of exchange and checks are same. Payable either to the order, that is, I promise to pay to X, or to his order, or to the bearer. Bearer is a legal word. Anyone who holds a negotiable instrument legally. The function of the instrument is to substitute. This is the point that you must now try to understand. Substitute for money or extension of credit. It's a substitute of cash payment or is an extension of credit. Right? By this definition, we have certain types of bill of negotiable instruments, promissory notes, wherein I say I promise to pay. Right? So if I take this, let me see whether I can write this. Anyway, doesn't matter. Promissory notes are a written document written by a person who agrees to pay certain amount of money sometime in the future. So I suppose the drawer of the promissory note. Drawer means the person who writes the promissory note. I take a piece of paper and I say I promise to pay X, rupees 10 lakhs, after 3 months from today, to X or his order or the bearer. Right? Then I sign it. I put a proper required revenue stamp, which is required. Right? I have created a promissory note. Based on this promissory note, I have promised to pay. Now, it's a legal promise. That is why it is known as a negotiable instrument. On the contrary, the X, the creditor who has sold the goods, draws the bill. He orders to Y. To Y he says, please pay rupees 10 lakh to me or to my order, right? Or the bearer after 3 months, or instead of saying after 3 months, on 4th March 2019. I sign it. I become a drawer of the bill of exchange, but it has no meaning till I take this bill to Y. Y reads the bill because the liability to pay on 4th March 2019 is Y. So Y will put the word I accept it. The moment he puts the word I accept it, it becomes a negotiable instrument called bill of exchange. You understand the point? So in case of promissory notes, the person who has to pay, he promises. So therefore he signs and it becomes a negotiable instrument. In case of bill of exchange, The person who has to receive the money draws the bill and sends the bill to the person who has to pay the bill. When that person puts the word I accept it, his acceptance and sign it, then it becomes a bill of exchange, negotiable instrument, and the person who accepts it, a drawee, becomes liable to make the payment on that. Cheque is a bill of exchange. Now, in case of a cheque, I have a bank account, so I am ordering the bank, please pay X. Right? Now, I am asking bank to pay. It is the relationship between me and the bank, bill of exchange. Now, bank need not accept it because the checks are being issued by the bank. So, it's presumed in the law that once a cheque is signed by the drawer, that is me, the bank's acceptance lies there. Alright? So, the only difference between bill of exchange and the cheque is between the drawer and the bank, whereas in the case of bill of exchange, it is between the drawer and another person other than the bank who has to accept it. Cheque, the acceptance is presumed because the cheque is issued by the bank. Alright, authorized by the bank. Now, what is the difference between promissory note and bill of exchange? Basically, both of them are negotiable instruments. In both of the things, payment is to be made in the future. The only difference is, in case of a promissory note, it is withdrawn, it is written by the person who has to pay it. Right, the promisor. Whereas in case of bill of exchange, it is written, it is drawn by a drawer who has to receive the money. And therefore, it has to be accepted by the person who has to pay. So, there is no acceptance in promissory note. There is a necessity of acceptance in bill of exchange. In cheque is also acceptance is there, but it is presumed. Since the cheque is issued by the bank's acceptance is there. Right. Government promissory notes, just like a promissory note, the legal tender money, 100 rupees note, 500 rupees note, they are all Reserve Bank of India's promissory notes. Okay. Delivery orders and custom receipts are not strictly speaking negotiable instruments, but they do have the characteristics of things. There may not be a payment. For example, now what is the word negotiable instrument? It is an instrument on which a person can collect the money, alright, on a particular date from a specified person. Now this right to collect the money can be sold, can be given to someone else, can be endorsed. That is why the word negotiable comes. So any instrument which are negotiable in this type, by transferring the right to collect the money or goods, are known as negotiable instruments. For example, I send the goods by truck from, say, Delhi to Mumbai, and I get an order by the truck owners, the transport owner, who says that I will deliver you the goods in Bombay to you or to the person whom you direct. So I collect the delivery order and endorse it to my agent in Mumbai. Now this becomes a negotiable instrument, a delivery order. Alright. Same is the custom receipts. Custom receipts are nothing but receipts of goods which have been imported, which have come to the port, and you can collect it. So since they have the characteristics of the negotiation, giving the person who receives the right to claim the goods, they are equal. Otherwise, we are not going to discuss it. Primarily, we are concerned with basically two types of negotiable instruments in our accounting treatment: promissory notes and bill of exchange. If you recall carefully, when we were discussing about the cash book with a bank column, we have already said checks issued, check received, deposited into the bank. So checks are always shown in our bank account of the cash book. And we have also discussed this in detail in bank reconciliation statement. So let us, with these two important points, let us try to understand. This is a typical promissory note that I thought you will be able to know. On demand. On demand means I will pay only when you come and show me this promissory notes. We, the firm, that is the drawer, promises to pay the Central Bank of India Limited, or order is sum of rupees so much, together with the interest, on such sum from the date at the rate of, from the date means the date of this instrument, that is 30th March 1939, and then with this so much rupees and all those things for value received, because I am not giving you this charity, I am giving you for already the consideration I have received, the value I have received, and signed by Northern Company, and that's given to you. Right? Now this is a typical example, a real promissory note. If you see, it's one of the very old promissory notes that has been written. Now, bill receivable book is one of the subsidiary book, if you recall, we have received. So, what is a bill receivable book? A bill, a promissory note, or bill of exchange. Both are called here bills. A promissory note or a bill of exchange on which I have to receive the money. The entity which is recording has to receive the money. For that entity, it becomes a bill receivable. So, it will be written in the bill receivable book. Number of the bill, every bill will have a number. Date of the receipt, when it was received, date of the bill written on the bill of exchange or a promissory note, from whom it was received, whether it has been received by the person who has drawn the bill or by some other person, acceptor. Who is acceptor means who has agreed to pay. If you recall in bill of exchange. In case of promissory note, you will say not applicable. Where payable, which is a place where it is payable. Term of the bill, whether it will be payable on demand or after 3 months of the date of the bill or on a specific date, and therefore the due date. Now I must tell you here the due date. In case of negotiable instruments, whenever the bills become payable or a negotiable instrument be payable, you add 3 days, 3 working days. So if it is the 5th is the date, and then you add 3, the due date becomes 8th. Alright? So if I say I promise to pay on 5th of March, the due date is 8th of March. Alright? So then ledger folio, why I write the ledger folio? Now the name of the person whom I have written, from whom received, I have to debit it. I have received, I have to credit it. So his name will be credited, that ledger folio. Amount rupees, what is the amount, and remarks, whether it has been received from the drawee or it's against certain bill or whatever the reports. Right? So this is a subsidiary book which will be posted to the ledger account. The total of subsidiary book, this bill receivable book for a period, will be transferred to the debit side of the account known as bill receivable account. It is an asset. It is shown in the liability side of the balance sheet. Now, on the contrary, I have a bill on which I have to pay. Right? It is my liability to pay. Or I have issued the bill to someone, a record of which I am having. So I maintain a record of the bill that I have issued on which my liability arises after 2 months or after 3 months, like that. So number of the bill, date of the bill on which, to whom given. I have given this bills payable to whom? Drawee. Who was the drawer? I myself, you say self. Pay, to whom you have made it to pay. Okay, payable to X or Y or his order. Where payable? I have agreed to make the payment to where. Term of the bill, like receivable book. Due date. What is the due date plus 3 days? Ledger folio. The person to whom I have given, alright, becomes the debtor. So I will debit his account. So his ledger folio, amount rupees, and date paid. Whenever you make the payment, first is the date issued, date of the bill, and then the date paid. These are 3 dates: date of the bill, due date, and date actually paid. You can pay earlier also. You can pay late also. That we will see. If you pay earlier, you get a rebate. If you pay late, you might have to pay an interest on all this. Alright.
Thanks for watching. Do not forget to click the subscribe button and hit the bell icon. Do like, comment and share. See you next time. Subscribe and hit the bell icon.